Good morning, everyone, and welcome to the Daily Hunt for Multibaggers. It's Wednesday, March 25th, 2026, and we're diving into the data collected yesterday, March 24th.
That's right. We sifted through a significant amount of market chatter this morning, flagging numerous stocks. The overall sentiment, it's a real mixed bag today, swinging from strong optimism for growth to some very pointed concerns about overvaluation and underlying risks.
Kicking things off with the big one today, Microsoft, ticker MSFT, which saw a whopping 235 mentions. While the community is slightly bullish, and frankly, I see why. It's perceived as beaten down and oversold, with a PE of 23.31 that looks attractive compared to some peers. Plus, a healthy 16.7% revenue growth and an impressive 39% net profit margin really show its fundamental strength. Bank of America reinstating coverage and calling it a drop-dead bargain just adds fuel to the fire. It's been a solid performer for us previously.
Hold on a minute, Ethan. While those profit margins are indeed stellar, we also saw concerns about the broader market correcting and some specific product critiques. And I have to mention, there's a highly anomalous debt-to-equity ratio of 31.539 in the data. Now, this is likely a data error given Microsoft's profile, but it's a huge red flag if accurate, and something that absolutely requires verification before any major moves. However, putting that anomaly aside, the underlying financials for Microsoft are strong, and its focus on AI should continue to drive growth. So I agree, for today's deep dive, Microsoft is a buy. Absolutely. Next up, Alphabet, Google, with 35 mentions. Despite a recent dip in share price, the fundamentals are looking really strong here. We're seeing 18% revenue growth and an incredible 32.81% net profit margin. Plus, insiders have been net purchasers of over 5 million shares, which is a massive vote of confidence. Alphabet is aggressively pushing its Gemini Mac app, showcasing its dedication to leading in AI. Wall Street is still bullish, and I think this dip presents a potential entry point for a quality tech giant.
Ethan, I concur on the strong revenue and profit margins, and the insider buying is definitely encouraging. However, we also have to acknowledge a somewhat high debt-to-equity ratio of 16.133, which is a metric I always keep a close eye on. While manageable for a company of Google's stature, it's something to monitor. Considering its long track record of strong performance and consistent buy ratings from us, and despite recent price volatility, I'm comfortable saying Alphabet, Google is a buy.
All right, let's talk about the Fundrise Innovation Fund, VICX, with 22 mentions. This one is, it's certainly generating a lot of buzz. Users are fascinated by its astronomical price surge and the exposure it offers to private AI companies like Anthropic and OpenAI. There's a perception of a high-risk, high-reward play for those looking for extreme growth.
High risk is an understatement, Ethan. From a KPI perspective, this is a glaring red flag. The fund is trading at a colossal 24 times its net asset value. Its market capitalization of around $10.7 billion for only $437 million of NAV is fundamentally irrational. It has zero operational profit, which means its value is purely speculative, divorced from actual business performance. The comments are overwhelmingly bearish, with users predicting an epic rug pull. Our previous rating was stay away, and given these financials and the rampant speculation, Fundrise Innovation Fund, VICX, is a definite stay away.
Shifting gears to NVIDIA, NVDA, with 19 mentions. Now, the analysis points to some bearish sentiment due to overvaluation concerns, but, NVIDIA is a powerhouse. They have phenomenal revenue growth at 73.2% and an incredible 55.6% net profit margin. Insiders have also been net purchasers. NVIDIA is synonymous with AI, and its dominance in the chip space is undeniable.
Yes, Ethan, NVIDIA's performance is indeed impressive, but the discussion around VICX's overvaluation is implicitly dragging NVIDIA into questions about the broader AI bubble. We're looking at a PE of 35.68 and an extremely high price-to-book ratio of 27.07. That signals a significant amount of future growth already priced in. Coupled with a high debt-to-equity ratio of 7.255, it's a very leveraged position. While the company is strong, the valuation multiples are extreme, and a potential market correction in AI could hit hard. Our last rating was a buy, but today, considering these elevated risks, NVIDIA, NVDA is a stay away.
Next, Penguin Solutions, PENG, with 16 mentions. The community sentiment here is overwhelmingly bullish. They're calling it an explosive setup in the AI space, with its CXL-based memory server solving the AI inference bottleneck. New leadership from Dell and AWS, plus a partnership with Dell and NVIDIA certification, really highlights its strategic positioning. Add to that significant insider buying, nearly 50% net shares purchased, and a potential short squeeze, and you've got a compelling growth story.
I hear the optimism, Ethan, but the KPIs tell a different story. A PE ratio of 80.91 is extremely high, especially when current revenue growth is a paltry 0.6% and net profit margin is only 1.86%. It also carries a high debt-to-equity ratio of 87.582. While the strategic moves sound promising and insider buying is a good sign, the current financials just don't support such an aggressive valuation. The risk-reward here is too skewed without concrete improvements in profitability. Penguin Solutions, PE&G, is a stay away.
All right, Commercial Metals Company, CMC, with 15 mentions. The initial bullish thesis for CMC revolved around the massive data center construction boom, positioning them as a key steel supplier. They boast micromill technology and benefit from domestic tariffs. Some users see this as a solid strategic play. But many users are highly skeptical, Ethan. They question whether data center steel demand will actually be significant enough to move the needle for CMC, suggesting it's a minor and temporary boost. My main concern is the significant discrepancy in the KPIs. The bullish post claimed an 8.4% net profit margin, but the actual KPI is only 5.465%. The PE of 16.53 is also higher than what was touted. With a high beta of 1.419, signaling increased volatility, and upcoming earnings that need to validate these claims, Commercial Metals Company, CMC, is a stay away. International Paper, IP, with 13 mentions. This company is making a significant long-term play. They're investing $225 million in a new sustainable packaging facility, which signals future growth potential. And crucially, insiders have been substantial net purchasers of shares, over 11% of their holdings, showing strong internal confidence, despite recent stock performance. Wells Fargo even maintained an equal weight rating. While I appreciate the long-term vision and the strong insider confidence, Ethan, the current financials for International Paper are concerning. We're looking at a negative net profit margin, negative EPS, and negative return on equity. The stock is near its 52-week low, reflecting significant underperformance. And let's not forget the high debt-to-equity ratio of 71.073. A 5.12% dividend yield looks attractive, but it's hard to sustain that with negative profitability. Until we see a concrete turnaround in their core financials, International Paper, IP, is a stay away.
Lastly, Agora API with 10 mentions. The community sentiment based on the posts is quite bullish on their strategic pivot. The company is reportedly building a serious AI plus energy team, shifting towards an intelligence stack with new hires from Microsoft and Adobe. They're aiming to integrate complex energy infrastructure with AI, and the market trends in API integration certainly support this direction. It sounds like they're positioning for a massive future.
This is another case where the strategic vision is compelling, Ethan, but the current financials are a huge red flag. Agora has an extremely high debt-to-equity ratio of 14.629. Both return on assets and operating margin are negative, meaning they are losing money from their core operations and not effectively utilizing their assets. The stock has been in a consistent downtrend. While the vision is exciting, the company needs to demonstrate that it can translate strategy into profitability and a healthier balance sheet. Agora API is a stay away.
Well, that was quite the deep dive today. Let's wrap it up with our compiled list for deeper analysis. Investigators buy Microsoft Corporation, MSFT, Alphabet Inc., Google. Investigators cautious buy none. Investigators speculative gamble, Penguin Solutions Inc., PENG. This podcast is for informational and entertainment purposes only. The content is generated by artificial intelligence and does not constitute financial advice. Listeners should conduct their own research or consult a licensed financial advisor before making investment decisions. We are not responsible for any losses incurred. The market is a wild place, and knowledge is your best asset. Thanks for tuning in to the Daily Hunt for Multibaggers. We'll be back tomorrow with more insights. Happy hunting.